Very good evening to all of you. Welcome to today's live practical session for demand supply trading methodology. Today we'll be doing our session number 29 for the year 2024. Myself Sujit Kakkar, and today is Sunday 28th of July 2024. And before we move ahead with the session, let's also get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we recently started with the WhatsApp channel, and that is where we keep you posted with our upcoming videos, our sessions. If we have any, let's say, offers coming up, that is where we'll also be updating you. So you can scan this QR code to join the WhatsApp channel. And in case you just want the direct link, you can find it in the description. You can click on that link and you'll be able to join this WhatsApp channel. Now, talking about today's session is practical application of demand supply methodology. Now, demand supply course which we used to offer was a paid course, but we have made it as an absolutely free course now. The link is available in the description. It is available in English as well as in Hindi language. So whichever language you're comfortable with, you can go through the course. That will help you understand the methodology Uh, in a theoretical way, but whatever you learn theoretically, unless and until you see practical examples, you don't get a very good understanding of how to apply all those things that were taught. And that is what we do in these sessions. Every weekend I do one session where I pick some examples, and to those examples we apply all these rules that we went through when you'll be going through your theoretical part, and that gives you that hands-on experience of how to plan trades very mechanically and very rule based. Now, the beauty of demand supply methodology is that we can pre-plan the areas where we would like to be buyers and sellers. So whenever I'm taking these sessions, we are not reviewing something which has already happened. We are always planning for the future, and that is the beauty. And see, the fact is, something which has already happened, anyone can pick any chart, can apply any indicator, oscillator, or whatever it might be. You can do any kind of analysis on it, and you can uh, show it. Okay, this was something which was valid when the prices were back into the zone. But planning it in advance is definitely a different ball game altogether, and that is what we try to do with demand supply. We always plan in advance, and just because we are planning it in advance does not mean that I just share the example with you and then we forget about it. Whatever examples I share with you, whenever they get triggered in the future, we also review them, right? So I'm taking care that from planning the trade to the execution of the trade to the management of the trade, everything is covered. But the only thing which I don't do is I don't give you the name of the symbol. And the reason for that is that these sessions are intended for educational purpose. I'm not here to give you calls, tips, or ready-made trading ideas. So that is why I never share the name of the symbols. I'll be showing you the examples, and when we are reviewing it, you will see it's exactly the same chart, and that is how we go about. Now, we do have one example which is getting carried forward from the previous session because that particular trade got triggered for us, but we did not get the exit. So we'll again start with the review of it, and once we are done with the review, then we'll take the example for today's session. So this was the one from the previous session. So that is where we talked about that we, gapped a little deeper into the zone, which is where you could have got a better entry. And talking about the target, if I change these settings to all demand supply structures, because for targets we don't require quality areas. Anything that is demand, anything that is supply will do. So we can see that when we came into the zone, our opposing zone was somewhere around here. So even if we go with our original entry price, we still have a little over 2:1. But since you could have got a deeper entry, your reward to risk ratio could have even been better. So we have still not reached our target price, and you can see on Friday we had a formation of a new demand area. Now, ideally, what we would want is that once the formation of this demand has violated an opposing supply, but the problem is we don't have any opposing supply in between. The very first supply is this, which is going to be your target one. Let's say if you want to have your target two, this can be your target two. But yes, this will still remain as an open trade. We'll track it for the next few sessions as well, unless and until we get an exit on this. Now, we did the analysis again for this on session number 27 for the year 2024. Which was conducted on 14th of July. And this was a type 1 trade for us, and the prices came into the zone on the 18th of July. That is when it got triggered, and we are still just following through to see what would be the outcome of this trade setup. So if you want to go through the analysis session, that is going to be the session number 27. All right, so Let's get started with our example for today. So just give me a second. Let me set it up so that we can start with today's example. All right, perfect. So I'm almost done. Great. So whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video, and the title of that video is how to start trading. So if you go into the description, you will be able to find the link. And during the session, if I talk about some videos or if I talk about some documents, do not panic or worry, where do I find these documents or where do I find these videos? All the links are available in the description. So once you go through that video will help you understand why it is very, very important for us to be a very mechanical and rule-based trader, what process needs to be followed, and everyone will have to go through that process, right? There is no bypassing that process. So the sooner you start with that process, the better it is going to be for you. So do ensure, go through that video, follow that process. You might have to do that process maybe twice, maybe thrice, but again, like I said, there is no bypassing it. You will have to do it, and that is how you start building up confidence in your analysis. That is how you start building up confidence in your trading, right? So it's very, very important, and that also helps you understand the benefit of being a rule-based trader. And once you get into that process, you will see eventually it will be much more easier for you to take control of your emotions and take your trades purely based on your rules, because once you see the outcomes, then you understand that yes, following the rules is much better versus following my emotions, right? And that is what we are trying to achieve, right? At the end of the day, we want to be a rule based trader, we don't want to be an emotion based trader. Anyways, so when it comes to being a rule based trader, it's easier said than done, because what you need to do is you need to have a trade plan for yourself. And when you're learning something new, maybe you're new to trading or maybe you're new to demand supply methodology, it's not so easy to create a trade plan. And to overcome this challenge, I have created a trade plan for you, which is a combination of two documents. The first one is your trade plan steps, which we can also call as the walkthrough or the flow chart. This tells us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, which are available in the rule book. So use the you know will be using the combination of these two documents during these practical sessions to understand how to plan trades very rule based and mechanically. Now, talking about this rule book, this is a conservative approach, but every person has a different personality style, different needs, different uh, trading purposes. So you can tweak that rule book with time, based on your experience, based on the kind of results you're looking for. So it's absolutely acceptable that those modifications can be done. But yes, at least you do have a starting point using which you can start planning your trades. So what is my step number one whenever we start planning our trades? Step one is to define your trade purpose. Now, what do we mean by trade purpose? Trade purpose implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit, right? So exit does not imply only profit exit. It can be profit, it can be break even, it can be in loss, any kind of exit. So now the question is, why are we starting with the trade purpose as our step number one? And the reason for that is, when we do our analysis, we use charts which are time-based charts, and we have n number of options available to us when it comes to time frames. So the very first challenge we go through is that there are so many time frames available to me. So out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first understanding our purpose of trade, because logically, the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that is why what I did is I divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, then I'm pretty sure all of you would have experienced that whenever the market opens, some symbols they'll gap up, some symbols they'll gap down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit, which is bigger than what you were expecting, which is not a bad thing, right? But if you get a gap against you, you can also lose more than what you were willing to lose on that trade, and that is going to hurt you a lot. And that is why it is very, very important for us to practice risk management early on. The reason is, when we are learning something new, you don't have expertise from day one. Initially, you're prone to making mistakes, which is where, if things they go south for you, it can hurt your account really badly. And that is why my recommendation is, initially your hourlies and dailies will be strictly intraday trades. Weekly, monthlies, we are not anticipating to get the exit the same day, so here we have no choice, but we'll have to keep these positions as overnight positions. But that does not mean for weekly, monthlies you cannot have gap against you. It can still happen, but since we are leaning against some bigger time frames, the probability definitely reduces. Plus, when we are using, we are planning weekly and monthly income trades, the zones are also a little wider, where even if you have a gap, at times it might not gap beyond your zone, right? So those things can also help. But yes, you can still have gaps against you. So as a rule, initially, hourly, dailies strictly intraday, weekly, monthlies overnight. With time, with experience, if you want to include daily income into overnight trades, not a challenge. It can be done. It's just that as a risk management rule, initially we are trying to avoid it. So step one is, I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, now from the rule book, I'll get to know what time frames I should be using. So if I go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame, it is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Now, every time frame has a designated purpose. Higher time frame is used for demand supply curve analysis, intermediate for trend. Lower time frame is the time frame where we identify areas of demand and supply for entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT. So now the question is that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example I opted, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our ACTS from. ACTS stands for stop loss entry, target, and size. And in case I need to use the refining time frame, it's going to be the 60 minutes chart, which can be used for multiple purposes, like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Now, mind it, this table, which is available on page 31, is specifically for the NSE market, because this market is open for a very short duration, which is about 6 hours and 15 minutes during the day. But if you're trading markets which are open for longer durations, like your commodities, forex, cryptos, let's say international stock market, which are open for longer durations, then you can refer to the table which is on page number 32. So coming back to our step number 1, because I opted I want to plan monthly income trades. Now I know my time frames will be monthly, weekly, daily, and 60. So my challenge number 1 is taken care of. I know my time frames. I know what analysis I'll be doing on each and every time frame. Next comes challenge number 2, and challenge number 2 is, yes, I do know my time frames, but let's take example of NSE market. On NSE, I have over 2000 companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need now is, I need a process in place which can help me select some scripts from a big enough list, so that if I have a small list, I can do my analysis on that, and I can see if I have something which is an exact replica of my trade plan. Now, very important, no matter what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those stocks or whatever markets you're trading. The job of the scanner screener is never to tell you what you need to buy or sell. The job of the scanner screener is, out of a big list, give you a smaller list, which has to be analyzed manually by you to identify which all symbols are an exact replica of your trade plan, and whatever are exact replica of your trade plan, they might be your trading opportunities. So how do we do this? A few examples. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages, and they can help you in shortlisting some symbols. Second example, on my YouTube channel, if you search for scanner, you'll find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis, you'll also be able to find a video on sector analysis which can help you with this. Sorry, fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find the video on top-down analysis which can again help you in shortlisting symbols. So these are 3-4 different examples, but you're not restricted only to these 3-4 different ways of shortlisting symbols. Let's look at few examples before we move ahead. So like I was talking about, that once you come to our website, under the free tab, you have stock screener option. Because I opted, I want to plan MIT trades, I can click on MIT. I can run the long scan and the short scan. So here you can see the long scan is shortlisting nothing for me, and the short scan is shortlisting 2 symbols for me. So like I already said, just because I'm getting these 2 symbols in the short scan does not mean I can blindly sell these 2. Similarly, if the long scan was giving me some symbols, does not mean I can blindly buy them. So the job of the scanner was that out of 2000 plus companies, it will help me get a smaller list. And now it gave me a list of only 2 symbols. I'll analyze these 2 symbols. I'll check whether any of these 2, they match with my trade plan. If the answer is yes, I have an opportunity. If the answer is no, I don't have an opportunity, right? That is how simple it is. Now, many times what can happen is maybe nothing is matching with your conditions. That is why nothing is getting shortlisted. Or maybe your list is a very small list. Now, obviously, if your list is small, it will be much more challenging to find a tradable opportunity, because out of 2, it's not that, 1 or maybe both of them will match with your trade plan. So if you want to have a little bigger list, what you can do is, in this scanner, you can see I have given 5 different conditions, out of which you will disable the third one. You will run the scan again, and I'll do exactly the same thing here. I'll disable the third one, run the scan again. So initially you saw that the long scan was not shortlisting anything for me, but as soon as I disable the third option, now it is giving me a list of 74 symbols. And if I go to the short scan, which was giving me 2, now it is giving me a list of 11 symbols. So instead of 2, now I have 85 symbols to look into, which I'll say is not a very big list. It's still a very small list, which can be easily analyzed. I'll say probably half an hour, 45 minutes. So if you're good with that, yes, you have a smaller list with you. But if you still feel it's a very big list, you further want to, let's say, filter it out, then you can say, okay, I don't want from the cash segment. I only want the ones which are getting traded in futures. I can run the scan again. Now you can see I have 27. If I further want to make it small, I can say, okay, only give me the ones which are from maybe the Nifty 50. Let's see, what do we have? Now we have a list of 8. So can you see, this is how you can filter based on your preferences, how big or how small you want the list to be. And this is not the only screener available to you. If you go to the screener section on this website, you can see you have over 150,000 scanners available on this particular website. Some of them are based on fundamental analysis. Then you have your top loved. You have your candlestick patterns. Then you have your range breakout, bullish scan. You have your bearish scans. Then you have your intraday bearish, intraday bullish crossovers. So n number of scanner screeners are available to you. Out of this, whatever you feel is the best fit for you, you can use that. And this is just one website. Similarly, if you do a Google search, you'll be able to find a number of websites, a number of scanner screeners. Whatever you wish to use, you can use that. Like in this example, we got a list of 85. But once you start analyzing them, there are a few more challenges which eventually you will realize. Challenge number 1 is, what you'll realize is that once you go through this list, majority of these symbols, they don't have a quality demand area or a supply area on the lower time frame to plan a trade. Because if you don't have a quality area, how do you participate, right? We first need to have a zone where the prices have to retrace, and only then you can participate. So that's your challenge number 1. And the reason for that is because whatever scanners we talked about, all these 150,000 plus scanners we talked about, they are not based on demand supply zones. They are either based on conventional technical analysis or fundamental analysis. So that is the reason, just because something is getting shortlisted does not guarantee that you'll have a quality area on the lower time frame. Now, few of them, even if they have some quality areas, those areas might be far from the current market price, due to which you will have a longer waiting period before the prices are back into your zone. And during that waiting period, whatever price action develops, it might disqualify the trade setup by the time it is back into your zone. So these are some of the challenges we will face when our scanners are based on conventional technical analysis or fundamental analysis. And what is the solution to overcome these challenges? I have created 2 custom built tools which are purely based on demand supply zones. The first one is called as the alert. The other one is called as the screener. Now, both of them are based on demand supply, but they function in a different way. So how do alerts they work? So what alerts they do is, as soon as you have a formation of a demand area or a supply area during the live market, right? So whatever is happening currently, As soon as the demand zone or a supply zone forms, you immediately get the notification. Now, if you want to have a better understanding of alerts, the link to the walkthrough video is available in the description. I'll just quickly show you an example, because for alerts, we do have a demo channel for NSE, MCX, and Forex. So here you can see these are the alerts for NSE for the 26th of July, which is Friday. So you can see as and when the zones were getting formed. Can you see at 11:15 we have an alert which is for daily time frame, then for 15 minutes, for 60 minutes, for 5 minutes, for 5 minutes, again for 15 minutes. You can see as and when these zones are getting formed, you keep getting these notifications. What is the name of the symbol? What is the structure, right? So whether it was a drop based rally, rally based rally, rally based drop, or a drop based drop, what is the proximal value, what is the distal value? But remember, these are not calls or tips. It is not telling you that this is the proximal, so you buy, or this is the distal and this is where your stop loss will be. It is only telling you you have a formation of a zone, go to this time frame, qualify that zone based on your trade plan. If it qualifies, it might be an opportunity for you. So again, it is a scanner, it is not a call giving or a tip giving service. So this is what alerts they basically do. They keep updating you live during the market as and when the zones are getting formed. What screener basically does is, it is not just considering the zones which are getting formed today, it is considering the zones which are formed today plus all the zones that formed in the past. That might be a day ago, a week ago, a month ago, a year ago, a decade ago, right? As long as you have those zones on the chart, it is taking care of all the zones. And what we do in the screener is we give our list of symbols. So here you can see, as an example, I've given a list of about 40 symbols because that is the max you can give in one screener. Now, if you have multiple chart layout, you can apply the screener multiple times. You can give the list multiple times. And once you have given your list, then you will select what is my proximity percentage. So what I've given is that out of these 40 symbols, shortlist the ones where my current candle is having 1% proximity to a demand area or a supply area. And can you see that is what it has shortlisted for me? The ones which are highlighted in green will be close to demand areas. The ones which are in red will be close to supply zones. So if I go to Bharti Airtel, you will see that will either have a demand area which is close to the current candle, or it will be formed on the current candle. Here you can see we have a demand zone which got formed on the current candle. Similarly, if I go to TechM, you will see will be closer to supply zone. PECHM. So let's zoom out a little bit and then you'll be able to see. Can you see that's where we have our supply zone and we are getting pretty close to it, and that is why it got shortlisted for us. And can you see it is not based on what was formed today. Now this supply zone was formed way back in January 2022, right? So it's over 2 years old zone, but the screener is still taking care of it because we need to be closer to those areas, and that is how it shortlists for us. And let's say if I want to do the same thing on a different time frame, I just need to change my time frame. So as of now, I was on daily. If I change it to weekly, now it will give me results based on the weekly time frame. So let's give it a few seconds. So here you can see now it is giving me based on weekly. So let's say I go to HDFC Life, Life. So either the current candle will be close to a demand area, or there'll be a formation of a demand area on the current candle, and that is the reason it is getting shortlisted for us. So that is how it works. And yes, those are the two tools which are available if you want to shortlist based on demand supply zones. But like I said, step 2 is to get a smaller list. How you want to get that small list, it's completely your choice. I have showed you a number of tools which are absolutely free. I have showed you 2 which are purely based on demand supply, but they are definitely subscription based. Process can be as simple as, I don't want to use any of these scanner screeners. I'll only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I only want to analyze. So choice is yours how you want to do it. But eventually you will definitely realize the more in sync you are with the demand and supply, the smaller will be the list and the higher will be the probability of finding a tradable opportunity. So let's assume you got a list, and in that list the very first company was ABC. So what am I supposed to do now? On ABC, I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1. When we opted that we want to plan monthly income trades, we got to know that as a monthly income trader, my lower time frame will be the daily chart. So here, lower time frame implies the daily time frame. And what am I supposed to do on the daily time frame? I need to identify a zone. By zone, we mean any of these 4 structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. Now, if I go to my charts, you can see I already have the demand supply zone indicator applied, which is identifying this drop based rally structure for me. Now, even if I disable it, you can see visually also you can identify it. Prices came down, paused for a while, started moving up. So, yes, I completely lean against the demand supply zone indicator. But when you start learning, we start with a concept which is called as boring exciting candles. You will see that initially, yes, it will help in training your eyes to identify these structures. But eventually, you will realize that every zone does not match with the boring exciting technique, right? So it's just a starting point for us. But once your eyes are trained, then what you need to do is you need to shift more towards understanding price action versus where are the boring and the exciting candles, right? So boring exciting is just a starting point for us uh, to train your eyes, right? That is what you need to do. All right, so here you can see we have a drop based rally. So let's draw this. Now you will see that today's analysis will be a little aggressive trade. Now going with the rule book that I've shared with you, you will see that it will not qualify. But when I share examples, I try to share different kind of examples. I try to show you different approaches so that you're not restricted only to what is given in the rule book. You're also learning how other things can be mixed and matched to plan some trades, and it's a beautiful example for such a scenario, and that is why I picked this as a example for today's session. So yes, we have identified the zone, which was our step number 4. Sorry, step number 3. So is the zone available? Answer is yes, we do have a zone available. Now, just because you have a zone does not mean you can trade it blindly. You'll have to qualify it now. For qualification, we have a 2-step process. In first step, we'll be qualifying it based on certain conditions, and in step 2, we'll be qualifying it based on the booster scoring. So the first one is the zone a case of level on top of level? Now, how do we verify that? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, it is referred to as case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if it is a coinciding level, it might be a case of level on top of level. But if it is not a coinciding level, it can never be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And the answer is yes. You can see here we do have this drop based rally, and the indicator is also marking it for us. So what I'll do is I'll mark it with a different color so that we can differentiate between the two. So the one in pink is my intermediate time frame zone. The one in green is my lower time frame zone. So if I go back to my lower time frame, is my lower time frame zone inside my intermediate time frame zone? The answer is yes, and that is what we call as a coinciding level. So we do have a coinciding level, but now the question is that do we have multiple levels to call it as a case of level on top of level? For that, it is not mandatory that the other zones might be quality areas. So I'll check mark all demand supply structures to see do we have any more zones inside of it. The answer is no. We don't have any more demand areas inside of it. So this is only a coinciding level, but not a case of level on top of level. So it's just a coinciding level, not a case of level on top of level. So we have verified, our condition number 1, level on top of level is not applicable. The zone is not because of a gap, therefore gap rules will not apply. Pivot non-authenticity definitely applicable, because whenever we talk about drop-based rallies and rally-based drops, we always consider them as by default pivot and non-authentic zones. So what we need to do now is, because we know these pivot and non-authentic zones have lower probability, we need to add some extra probability by looking at some positive factors. So what are those positive factors? If you go with the aggressive rule that I've given you in the rule book, the aggressive rule says that the move from the zone should have violated an opposing zone. So this is demand, then the opposing zone will be supply. So this move should have violated a supply area, but that supply area should not be of the same time frame. It should be of the intermediate time frame. So let's verify that did the move from this area violate a zone on the intermediate time frame. So here you can see the move from this area is this, but it has not yet violated any supply. This is where we have our nearest supply. Only when the prices that go above the distal line of the supply will say this is qualified for us. So as of now, this is not qualified for us if we are following the aggressive rule. Now, if you are going with the conservative rule says that the move from the zone should have created an impulsive move, which we definitely have. You can see this is my last pivot high. This high is higher than the last pivot high. So we definitely have an impulsive move. So my condition number 1 is applicable. And the condition number 2 is that on my refining time frame, I need an authentic zone. So here the refining time frame is 60. And on the 60 minutes, you can see we don't have any authentic zone. Here also we have a drop-based rally structure. Authentic zone would mean a rally-based rally structure, which we don't have in this case. So the fact is, irrespective whether you're applying the conservative rule or the aggressive rule, once you're on this process of pivot and or authenticity, based on the rule book that I've given to you, when we talk about is the zone qualified, the answer is no. You're done with this symbol. You'll move on to another symbol. You'll plan something else, right? So now I'm talking about a trader who's following exactly the rules that I've given you in the rule book, right? Because see, the trade plan steps will remain exactly the same for everyone, irrespective whether you're an aggressive trader, conservative trader, whatever your personality style will be. It's just that the rules of these conditions you might modify. Now, what we were trying to do is we were trying to add some positive factors because of case of level on top of level. Now, when we were applying the conservative rule, we already got one positive factor, and that one positive factor was we already have an impulsive move, right? So my condition number 1 is true. But what I also saw that this is also a case of a coinciding level, which is a positive factor, right? So can you see if I wanted to add a positive factor, now I have another positive factor, which is a coinciding level. So maybe instead of, somebody might have a rule that, yes, if I see a pivot and authentic zone, I will only trade it if I have an impulsive move, and it also needs to be a coinciding level. And that is where I'm getting my positive factor from. So absolutely acceptable, right? Nothing wrong with that. It's just not, it doesn't mean, if I've given you a rule book, that is the only way you can have those positive factors. Once you start applying this methodology, you will see there are a number of ways to add that positive factors. Another way can be, okay, the first condition is maybe I need an impulsive move, and second is I need to be at the best location. So if it is at the best location, you still have a positive factor with you, right? So you can see you can add those positive factors different ways. So in this case, yes, going with the rule book that I've given you, it is not qualified, but that is why now I'm calling it as an aggressive trade, because I'm using a different approach but still having that positive factor. And in this case, that two positive factors are we have an impulsive move, we have a coinciding level. Now it was not a case of unstable equilibrium. So after applying the modified rules, is the zone qualified? The answer is yes. Now once I have qualified the zone, now we'll move on to the booster scoring. So let's do that. Give me a second. First one is freshness. The zone is definitely fresh, gets a score of 3. Strength, we have an explosive move. Time, we have only 2 candles in the basing. Reward to risk ratio will take as an assumption, because we'll only get to know how is the reward to risk ratio when the prices are almost about to enter the zone. Next, what is the location? Now, if I go to the monthly time frame, you will see that we do have a demand area, but we don't have any supply. And we have taken such cases many times. What we do is we take the reference point and we draw our curve. And now you can see I'm planning my trade low on the curve. Low on the curve is a good location to plan a long trade. So we'll give it a score of 1. Trend, the indicator is telling us we are in sideways, gets a score of 0.5. Move from the zone, we need minimum 4:1, which has already happened in this case. So you can see if I go from here till here, we already have a move which is 4:1, gets a score of 2. It is not a case of level on top of level, but definitely a coinciding level. And for trap, I can also give it a score of 1. And the reason is if I just take a horizontal line here, let me zoom out a little bit and start pushing it up. You can see this area is almost like a textbook example of support and resistance. You can see almost resistance. Here also you can see it working like resistance, almost resistance, then work like support, working like resistance, again working like support. And people who believe in support resistance as support, this is where they'll be buying. When the prices are again back, they'll try to buy. And their stop losses will be placed below this, which will be sell orders. And if we get a breakout traders will also sell by the time we are entering into this area. And these people are now making two novice mistake. Mistake number 1, selling after a decline means selling at a cheaper price and selling in an area where the chart has proven to us that back in history demand exceeded supply, which is the only reason for prices to move up. So yes, that possibility is there that it might work like a trap, for which we'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 for quality, definitely with the assumption of reward to risk ratio, and 5.5 for probability, which makes it as a high probability trade setup. So high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know this is a type 1 opportunity for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. Always remember that. And that is why we need to be ready with our risk management, where we'll do a proper position size calculation, so that if in case the trade does not go in my favor, I do not lose more than what my risk management allows me to lose. So you do your position size calculation. Now, whenever the prices are back, you'll have to re-verify. Again, the reason is markets are not static, markets are dynamic, conditions are changing almost every other second. So you'll have to always re-verify before placing your order. If it is qualified, yes, you place your order based on the entry type, in this case, a type 1 trade. And once your order has been executed, the last step is your trade management, which we are already seeing in the case of the trade which got triggered last week. Today also we reviewed it. So that is where we'll be seeing how to manage our trade. And the rules we follow is 1:1 we make it break even. After that, if we get the opportunity to trail onto it, we start using our trailing stop loss unless and until we get the exit. So this is how we plan trades, very mechanically, very rule based, and that takes care of today's example. Now, before we get into the Q&As, let me again add, if you are not subscribed to my channel, you can subscribe to it to get the notifications whenever I'm taking these sessions. And if you're available, you can join it live. In case you're not available, at least you will know that a session happened and you can watch the recording later. If you're liking these sessions, you can definitely hit the thumbs up button. You can like the videos. And if you have any friends, family members who are into trading, or if you're part of some trading group, you can also share the link to my courses, link to these videos. It might be helpful to somebody who might still be struggling with trading. So yes, let's see what do we have in the chat box now. All right. So earlier you used to mark demand and supply in Nifty, Bank Nifty, and few other segments that helped in understanding the market outlook. Can you start doing that again? See, Rakesh, yes, I was doing that, but that was the time, we were not teaching the methodology as a free course. We were, teaching the methodology in our paid courses. But now, since we have moved on to the next step, right, we are teaching you the whole methodology for free. So just marking the zones on the chart versus walking you through, walking you through the complete process is much more, I'll say, educational. And that is the reason we shifted to this, that let's not just simply mark zones on the chart. Let's understand how to identify only the quality areas, right? So I don't think it will be feasible to get back to where we started from, because we have already done an upgrade, right? Going back to it will be more of a downgrade, which would be a very big challenge. All right, so yes, there were a few highs and hellos, right? Highs, hellos to everyone. All right, recently launched demand supply alert is for those who does not have paid TradingView subscription, right? See, it's not specifically for those who do not have paid subscription. It is for everyone, whether you have a paid subscription, whether you don't have a paid subscription. But yes, see, the disadvantage was initially people who were not having paid subscription for TradingView, they could only place one alert, and in that one alert you can only have one symbol and for one time frame, right? So example, for let's say Nifty, for Nifty, if I place an alert for 15 minutes time frame, my one is utilized, I cannot place any more alerts, right? So that is the challenge for people who are having free account. Now, even if you have a free account, for these 15 minutes time frame, you can still add up to 40 symbols, right? So that is the only advantage you're getting if you have a free account. Now, a person who has a paid account, they can place now a number of alerts placed on their subscription level. So let's say you have the premium subscription where you can place up to 4 alerts. So now I can place 40 symbols for 15 minutes time frame. I can place 40 symbols for 60 minutes time frame. I can place 40 symbols for, let's say, a daily time frame. Then I can use another set of, so these can be 0 to 40, 0 to 40. Then I can have a set of 40 to 80, right? The next 40 symbols, I can again do the same thing. And I can do it for multiple symbols and multiple time frames. So the only advantage which people who were having free trading view account, they are getting is that in one alert, now they are able to monitor up to 40 symbols, but yes, limited to one single time frame, right? So that's the only advantage. All right, so how to use our scanner effectively for finding trades? See, the way I do it is because we know that we'll only be planning trades on the lower time frame. So what I do is I always use it on the lower time frame. So as an example, if I'm planning MIT trades, I will always run it on the daily time frame with my quality settings for the lower time frame, so that I know which symbols are coming closer to my zone. Once I've identified, okay, these are the symbols which are coming closer to my zone, that is where then I'll do my analysis. If they qualify, they can be opportunities. Now, example, all these, practical examples that I share with you, right? We are on session number 29, right? So all these 29 examples I shared with you, they were all shortlisted by the screener, right? It's not that I'm doing it any other way. I'm doing it exactly using the screener, and that is how I shortlist it for you. And that is why you will see most of the times we are closer to the zone, and that is why we get quite a few fills every other month. All right. Would you please check Nasdaq? So again, in this session, we are not specifically looking into any symbols. The fact is, even the symbol that we are looking into, I don't disclose the name of it. So that is how we'll be keeping it. So not getting into any specific symbols, right? So that is how it is going to be. Okay, so I use TradingView to scan for candidates with a few key conditions to keep the list short and concise. Any advice as to how should I use demand supply tools to narrow down trading opportunities? So again, see, it completely depends what kind of trades you're taking, right? Let's say if you are more into swing trading and investing, then I'll say screener would be a better option, because once you have your list of symbols with you, let's say you have a list of 50 symbols, now you can put those 50 symbols into the screener and you can ask, okay, out of these 50 symbols, which symbols are closer to my demand area or my supply area, so that I can plan my trades, right? So that is how it can work for you if you are a swing trader or a investor, which I can say it's more like WITs and MITs. Now, if you're more into intraday trading, then I'll say alerts can be more beneficial, because then you know, okay, these are my 50 symbols that I've identified. Now I want to get updated as soon as we have a formation of a demand area or a formation of a supply area on the chart, so that during the live market, I don't miss those opportunities. So again, it all depends what kind of trades you're taking, your availability. Now, let's say if you do intraday trading, but you still don't have time to do your analysis during the live market, and you're always doing it by the end of the day, then any of the two tools can be helpful to you. So you'll have to check what is more useful to you, whether you want to be notified as soon as the zone is formed, or whether when the prices are getting closer to the zone, that is going to help you more. Based on that, you can always make your decision. But yes, we also have an option where you get best of the both worlds at a discounted price. So we have an option where you can go for the combo of both these tools combined together, and you definitely get a much a discounted price for it. All right, anyways. I know demand supply methodology uses multiple time frames. When you go through the steps in the trading plan, the objective is to see when prices reaches the lower time frame to trigger the entry. Absolutely. See, again, let me put it this way. If I ask somebody what is more important in a car, right? Somebody might say, okay, it's the tires. Somebody might say maybe it's the engine. Third person might say maybe it's the steering wheel. Fourth person might say, okay, it's the brakes. But at the end of the day, everything has its own importance. So it's not that we are only looking at the lower time frame for the, see, absolutely will always be taking the entry at the lower time frame. But what if that lower time frame zone is not located at a feasible location for me, right? So still I don't want to take that entry. So everything has its importance. It's more like you have these pieces of puzzles. You're putting it all together to understand the whole picture and then making your decision, right? But yes, the entries are always at the lower time frame, but in conjunction with what is also happening on the other time frames. All right, so meant to say that the price reaches the demand zone in the lower time frame to categorize the type of entry you will use based on the overall booster scoring. Absolutely, right? So that is what we are doing. Given for the fact the review of the steps done does not pass this, okay, it is it absolute and fast rule to reject the trade because you identified other factors that might pass the screen. So can you see whatever you asked today, we had a similar example, right? Whatever I have given you in the rule book today, I showed you a variation of it. So see, what we are doing here is when you are learning, we are starting with a rule based system because you lack that experience. Once you start having that experience, then you understand that you can mix and match different things, and that is absolutely acceptable, right? There is nothing wrong with that. It's just that when you are lacking that experience, I need to be very conservative, right? So that is why we are following some set of rules, because if you have too many things to apply from the very first day, it becomes much more complex. So yes, if you see that there are positive factors which are supporting you, and like I said, the rule book that I've given you is a conservative approach, right? Different people, they can have different rules for different conditions, so those modifications can be done. So a trade setup might not match with one person's trade plan, but might match with another person's trade plan, because he might have a different rule for it. And coming to that point, I would also like to add, now some of you might say, okay, Sujit, you say demand supply is a rule based methodology, but now different people are having different rules. So how come it is a rule based methodology? Now let me give you a very simple analogy of it. I think I have given this in the past, but maybe you probably would have attended that session, not attended that session, I have no idea, but let me give you that example. Let's say I go to three different restaurants and I order the same dish, right? So let's say I order pizza, right? And that too a simple margarita pizza. Now, will it taste exactly the same at Domino's, at Pizza Hut, or maybe at Papa John's? The answer is no, right? All of them, they have their own flavor. But if you look at the ingredients, I'll say probably 99% of the ingredients are exactly the same. So even if the ingredients are same, why does the taste differ? Because everyone has, every chef has their own personality style, right? Some might like it a little spicy, the other one might like it a little different way. Some might like more of seasoning into it. Next one might like, might like it a little bit more sweet, and that is where the difference comes in the flavor of the pizza. But if you look at the ingredients, like I said, 99% or maybe even 100% of the ingredients are exactly the same. So similarly, if you talk about three different traders, right, one might be very aggressive. Sorry, let's do this. One might be very aggressive, the other might be aggressive, and the third one might be very conservative, right? But now, if you look into this, ingredients for all three of them are exactly the same. They are looking for the same structures of the demand, same structures of supply, same boosters, same rules. I mean, not the same rules, same concepts for level on top of level, right? Same concept for unstable equilibrium. But when it comes to planning their rules, right? Their rules can differ. Now, a very aggressive trader might say that I'm comfortable trading all locations. But an aggressive trader might say, I will not trade all locations. I will only trade maybe the low of the curve and very low of the curve when it comes to long opportunity. Very conservative trader might say, I only want to trade the very low of the curve. So can you see, curve, everyone is using the same thing, how to find the curve. So ingredients are remaining the same, but your rules are changing, right? So yes, rules can differ, but ingredients will always remain the same irrespective what your personality style is. All right. So how to incorporate these additional rules to ensure that we don't completely discard the potential trade? Please elaborate. See, again, this is something which only comes with experience, and that is why when I'm sharing these examples with you, I try to bring in different kind of examples so that you can learn from it. It's not that it is one thing which I mean, it's not something which I already have it as a uh, as a copy created for me. So it's just that when I see different things on the chart, I share those with you based on my experience, and that is how you learn, right? It's all about experience, right? And that's how it is. So the more number of sessions you'll watch, the more you'll learn from it, and that is why I always keep saying that make sure that you people go through at least 50 or 100 sessions, because uh, every session you might find something new to learn from. But once you have gone through, let's say, 50 or 100 sessions, then you will see that things are getting boring for you, because everything is getting repetitive. So once you feel that now these sessions are boring for you, you have reached that level, right, where you are understanding everything, you have that experience. But unless and until it gets boring for you, you are still getting something new to learn from, just keep coming back to these sessions, keep attending these sessions, and that is how you gain that experience, right? That's the only thing. All right. Really enjoy the live sessions. They are helping solidify my knowledge of demand supply methodology. All right. Happy to know that. When will be the next batch? You mean next batch for what? Paid sessions? I'm not doing any more paid sessions. All my all my courses are now absolutely free course. Even these live sessions which are doing, I'm doing them as absolutely free. So when you're getting everything which was paid first for free, why do you want me to do paid sessions, right? So all the sessions are free. But yes, if you're talking about when will be you talked about the batch. So again, no paid sessions. Whatever was there in the paid session, now you're getting absolutely free, and that is how it's gonna be. Anniversary discount. Let's see what happens this time, because at times we do, at times we don't. In fact, now we don't even have any paid courses. And if you talk about the tools we have, they're already priced as good as free, right? So I'm not sure whether we'll be providing any discounts on it, but let's see. Once we come to the anniversary month, we'll think about it. All right. So thanks for the clarification. You're most welcome. Demand supply alerts can be used for cryptos, forex. Do we need to pay additional subscription for the alerts? See again, when you're placing your custom alerts using the latest demand supply alert indicator, you can use any symbol which is available on the trading view. You do not have to subscribe for different markets. It's just that when people are having free trading view account, we give them this opportunity that from our end we give you the alerts for NSC, for MCX, and for few forex symbol. So this is where you can choose one of these, because these are provided through our Telegram channel. But when you're applying the indicator on the chart, which is the demand supply zone alert indicator, you're not restricted to any one market. That indicator can be utilized for any market, any time frame which is available on TradingView, be that stocks, commodities, cryptocurrencies, Indian markets, international markets, doesn't make any difference. As long as you have a chart available on TradingView, everything will work. All right, so that answers your query. Let's see what do we have next. Thanks again for helping us connect the dots when analyzing potential trade setups using demand supply methodology, understanding how to plan and evaluate trading opportunities. Most welcome. Learning is never ending. Absolutely. Right. That is something which I completely agree with. Specifically when it comes to trading, I'll say everything you have something new to learn from. But yeah, it is definitely a never ending game. You're absolutely right. Experience will come as you go through the exercises and absolutely great. Perfect. So that brings us to the end of today's session. Thank you so much for joining in. I'll be seeing you now next weekend. Until then, trade safe. Enjoy your evening. Take care. Bye bye.